So our class today is market structure. And under market structure, so these are the main topics that you're going to have a look at. The first topic will be identifying the break of structures, and the change of characters. Sorry. And the change of characters. Then from there, we are going to have a look at internal and external market structures. So we have external and internal market structures. Okay, so those are the two main topics that you're going to have a look at. And we're also going to have a look at how to mark the varied break of structures and varied change of characters. So yesterday, I remember introducing about the market phases. Okay, we discussed about uptrend, downtrend, and the consolidation phase. So this is just a continuation. So whenever you have a clear uptrend, like that, okay? So you have 1, 2, 3, this move here. So above this area here, that's why you have the break of structure, okay? So here you have the BOS. So what is a break of structure and what does it signify? So the break of structure here signifies continuation in the market structure, okay, or wherever the trend. So it's continuation in the trend. That's what a break of structure signifies. It shows that if you're on buys, you're on a clear uptrend. It shows that buyers are willing to continue pushing higher. Okay, we'll come to a change of character. So let me talk first of the break of structures. So this break of structures, as I said, it signifies buyers are willing to continue higher. So you see the market then retrace and continue up again. So here we'll have another break of structure. Okay. So one, about when it comes to break of structures, we usually have so this is our higher low, higher high. Then at this point we have our higher low. Okay. We have our higher high, and on the lower side we have the higher low. Okay, so that's what you're going to see in the market: the higher high, the higher low, the market making and when it comes to varied, okay, the break of structures, okay, we want to see the market break the higher highs and maintain the higher lows. So one, you're going to notice that this low here has not been broken by this low. Because if the market closes below, then it's going to be something else. Then, when you mark the break of structures, sometimes you usually have, let me draw something here. Okay, let's say that you have something of that sort. Okay, like you're looking into the market and you don't know how to actually go about this. So that's why we are going to look at, this reversal here, this pullback might be something that looks like this, So you always mark the highest point and the lowest point in the market. So you have to ask yourself, where is the highest point? Because you don't go marking, the break of structures at this point. Okay? You don't mark just anywhere, because I have seen that, depending on the students that you have. So you need to ask yourself, where is the highest point? That's why we are saying higher high and higher low. So in this case here, we have our highest point as this area. So that's why you are going to have the break of structure at, so at that area there. Okay? Then, where do you have the lowest point? This is not a break of structure. Why? Okay, we are going to come to that point, because others might think that now because the market closed above here, then you need to ask yourself, where is the second highest point? Because the break of structures are marked between the higher high and the next highest point, which is this area here. Okay, then it's low. You have to ask yourself where it's low. This area, it has not taken out this area here. Okay, so the rest here, you just ignore the noise in the market, because that is one thing that usually confuses most people. I'm going to get to the market, and I'll show you how you mark both the internal and external market structures and all that. Okay, so I hope that you have understood the point. So also, when you're on a clear downtrend, the same thing is true. Okay, so on a clear downtrend, you expect the market to behave in the same way, whereby you expect the market to break the lower lows. So that's the point where you're going to have the break of structure. And as I said, the break of structures signify a continuation in the market trend. Okay, so here you have your lower low, this is our lower high. Okay, yeah, then remember that this is the run, the dominant trend where the sellers are heading to. We call it the run of the impulsive move. Then these ones are called the pullbacks, these ones which you can see here, the pullbacks. Then we have the runs or the impulsive move. So also on a clear downtrend, you don't expect the market to take out the highs. So if these highs are taken out, then it's something else. So what if, okay, what if the market closes, the market makes a retracement and closes below this area here? Okay, so let's leave it first at that point. So if the market comes to this area here, two things should ring in your mind. Okay, one is what you call change of character, and the second thing is liquidity sweep. Okay, so what is the difference between the two? So for a change of character signify change in market direction. Okay, so we are going to have a shift, okay, from an uptrend to a downtrend. So if the market closes below here, so you expect to, if it's a change of character, you expect the market to do this, move up and not close above this high. So you expect the market to just retrace on the upper side and continue with the normal direction. So you will have the market do something of that sort. Okay, so what is the difference? The difference comes in if you have the the break of structure there. So if that break of structure happens, everything else changes. Now you should be looking for sell opportunities and not buy opportunities. Okay, so same thing. If the market closes above here, okay, and does something of that sort, whereby we have a change of character here, and the market should give a valid break of structure. Okay, so this now tells us that we have already shifted, and now we are looking for buy positions. So this will be our higher low. By this point here, we'll have our higher high and our higher low. So you expect now the market to continue with the same thing. Okay, same thing here. You expect the market to continue with the same thing. So the market will retrace perhaps to an area where we have a supply zone and continue with the normal downtrend, breaking structures to the downside. Okay, so that is now for a change of character. And I've said that it signifies changing market direction. Okay, so what if something else happens, which is this? So let me show you. So let me remove everything here. Let me remove everything. Okay, so I told you that two things might happen if the market closes below here. So what is the second thing? The second thing is, what if the market does not do this and just continues with the normal direction and closes above here? So this will not be a change of character because you have not shifted in any direction. So what this will be, we refer it to liquidity sweep. Okay, so the market will be hunting for liquidity below this area here. Okay, so that will be liquidity sweep. And the market will continue with the normal direction up. So initially we had this as our varied break of structure. Remember, okay, I've not said that. So I'll get to that. Okay, then same thing. If you see the market close above a high, a protected high, and continue with the same direction without changing, so you expect to have a valid change of character at this point here. So you will have like the market continue with the normal direction, and this will no longer be a change of character but liquidity sweep. So I hope now people know the difference between the two. Okay, liquidity sweep happens if the market continues in the normal direction. Change of character happens if you spot the market close here with a body and change the direction, and that change, you're going to tell that the market has changed if you see a break of structure. If the break of structure has not occurred after a change of character, then you still don't have the assurance that the market has changed. Okay, and so that now brings me to my points. So how do you mark varied break of structures? The first thing that you need to know. So the criteria or considerations for varied break of structures. So we have 4 points. Point number 1, we mark between the highest and the lowest point. the market. Second point, so second point will be imbalance. We must spot imbalance. I'll tell you what that means. Point number 3, the previous high or low should not be taken out, okay, comma, and if it's taken out, you have two things that can happen. So which I said that one can be a change of character or liquidity sweep. Point number 4, use the Fibonacci retracement tool. It should give you 0.382. So those are the 4 points that you're going to have a look at for varied breakout structures. So let me start with the first one. So when the market is moving up like this, you mark the varied breakout structures. Remember, I said that there is a very huge difference between a swing high, a swing low, and higher high, higher low, or a lower high, lower low. So let's say if you are on a, okay, when you are on an uptrend, so if I'm to mark the breakout structures here, where do I mark them? Let me change the color. So where do I mark the breakout structures here? So when the market is moving, I will mark the breakout structure first at that point. Okay, so imagining that nothing still has happened here. Okay, first ignore this one. Okay, but when this low is taken out, if this low is taken out, it means that the market went for liquidity sweep. Okay, so the market went to hunt for liquidity and continued with the normal direction. So where we be, which is the highest point here? So the highest point becomes that area there, because that is where we have the highest point and its lowest point. Okay, so this, you treat this, whatever happens here, you treat it as a single trend. Okay, so we'll have our higher high and our higher low at that point. So then the market, you can see, continues. So this is just a swing high, a swing low, swing high, swing low, but it's a higher high, higher low. Then we have this point. Okay, we have this and this. Is this the highest point? No. So we don't mark our breakout structure here. We mark it at the highest point, which is this area. So you'll mark at this point here. Okay, and not here. Okay, so I hope now people will not make that mistake, because this is the highest point, the lowest point. Okay, and the vice versa is true. Okay, so if you have your lower low, and here we have our lower high. Okay, so where do we have our highest point? This is not the highest point, so we not have our breakout structure here, because we had the market sweep liquidity above this point, giving us a new high. Okay, then the market continues down, gives a breakout structure there. This, we are not going to mark a breakout structure here, okay, because the market went high. Okay, to sweep also liquidity above this point. Okay, yeah. So I hope now people understand that and the difference. Okay, point number 2, imbalance. What is imbalance in this case? We have the imbalance of the fair value gap, okay, when the market is inefficient. And we have the imbalance of the break of structures. What is now? What do I mean by this? In this case, I'm talking about, you see, when the market breaks this high, so the distance between higher high and another higher high is basically what we call the imbalance. So if the market breaks structure here, this from this area to this area, that is the imbalance I'm talking about. Okay, it signifies that buyers are willing to continue pushing the market higher. Okay, so it's the push upwards before the next pullback. Before this pullback happens, we need to see this. Before this pullback happens, we want to see that buyers are willing to push the market higher. If you ever see something of this sort in the market, if you see something like this, you have the market, then the imbalance starts fading away. There is very high probability that sellers are ready to take over the market and push the market lower. So this area here, it shows that sellers, are now entering the market and buyers are fading away. Have a look at most times when the market is about to shift. You're going to notice that you have like low imbalance, small candlesticks printing, then the market shifts. So that's what I mean. Also on a downtrend, the distance between here and here before this pullback happens, it's the imbalance. We need to see sellers pushing the market lower. Okay, yeah. So that is point number 2. The previous low and the previous high or the low, depending on the trend, should not be taken out. And if it's taken out, so this is we have our first low and we have our second low. So this is the most recent. Okay, so it's the previous low. So if the market takes out this, okay, let me put it, if the recent, so the previous or recent. So if this area is taken out and the market closes below here, then you should know that, one, a change of character has occurred. That is, if you see something, of this sort, that's a change of character. If the market shifts and gives a valid break of structure, and that tells you that for a valid change of character, so the criteria for marking a valid change of character, what do you need? You need 2 things. Point number 1, the market must close with a body of a candlestick and not a wick. Okay, so if you ever spot the market, it closed below the recent low with a wick. Okay, that's also that's not a change of character, but a liquidity sweep also. Okay, it means that the market was just, okay, there is the difference. If you spot a wick, okay, so if it's a wick, it's a liquidity grab. Okay, so liquidity grab, you need the market to snap and close immediately above with a body, then continue up. For liquidity sweep, you need bodies. Okay, so you need a body. So if the market closes with a wick, okay, for a valid break of structure, you need the market to close with a body. Okay, and that's not just it, because if it closes with a body, it can be a liquidity sweep. If it closes with a wick, it can be liquidity grab. Okay, so the second point now is must be followed by a valid BOS. Okay, you must have a valid break of structure to follow that. So if you don't see the valid break of structure happen here, how are you going to tell us that the market has shifted? You know, because why? Sometimes the market, how does the market induce traders? Okay, so this is how inducement happens. Let me show you. If the market, you know, if the market closes the body yes, you're going to find yourself having a supply zone somewhere around here, in between here. And you'll think that the market will come back here and you're going to set from that area. Only for the market to do that and continue up. I don't know if you have ever seen such scenarios. Yes, the market respected the supply zone, but you know, the supply zone was not able to hold. Okay, so the market just went up because it was seeking for liquidity. So what is the safest way to trade the change of characters? The safest way to trade the change of characters is, but I know most people will not do that, is wait for the market to close with a valid break of structure, wait for the retracement, now take your trade when you'll be having your second break of structure forming. Okay, unless you have other conferences here, around here. Okay, that's maybe the only way that you can survive. Okay, but if you just spot maybe the market just give you a change of character, you're not guaranteed that this area of supply here or on a downtrend, the area of demand will be able to hold. Okay, yeah. So the fourth point, the Fibonacci retracement tool. Okay, so sometimes I find people, you know, you spot the market, yes, moving up, you know, moving up, and you spot some red candlesticks, you know, and you think you're going to think that these areas here, because you have red candlesticks, that they are break of structures. No, for a valid break of structure, if you take your Fibonacci from the beginning of the trend, so where is the beginning? So the Fibonacci is this Fib retracement under this area here. It's the third on your drawing tools. Okay, so take your Fibonacci, draw from the bottom there to the top. If the market does not touch this, you see this line, the yellow one, this one, or the orange. If the market does not touch or close, if the market goes deep, that's a deep retracement. It's a valid one. But if the market comes here, you see inside, somewhere inside there, this is not a valid break of structure. It's just the market. So this is just a single trend. Okay? It's just a single trend. You don't have a pullback. So you wait for the next pullback to happen. Okay? So you take your Fibonacci all the way to the top. So let's say that this one, the market retraced like that. So this is now a valid one. So your first break of structure will be here, okay, and not at this point, because you know if you bring in the Fibonacci, it had not touched 0.382. So that's why you find, I don't know if you have ever seen the market coming below a point to liquidate, you know, those people who thought that this was a valid break of structure. You know, the market comes, takes out liquidity of the early buyers, and continues with the normal trend. So that is how liquidity and inducement is engineered. Okay, and that's how people get, you know, you get induced, and you say like, oh, the market is manipulating me. No, the market is not manipulating you. It's just following, you know, whatever it does best. Okay. So we have 3 minutes. Let me send the link so that now we can get to the charts, and I'll try to cement whatever I've just said.